Palantir reported their earnings this week, and we want to find out, is Palantir a stock that can return us 10, 20, 100 times the initial investment that we were to put in if we were to buy at today's price? We're going to take a look at the historical performance of Palantir. We're going to run through their income statement, look at their revenue growth year on year, their bottom line, their net income, how that has mirrored their increase in their revenue. We're going to take a look at the health of their balance sheet, see whether they have a strong balance sheet, compare their total cash to total debt. We are going to run through their earnings and some interesting information that we have just found out. We are going to look at some financial metrics for Palantir Technologies. And as always, we are going to run it through our stock valuation model, getting to our intrinsic value and finding our acceptable buy price. Now, Palantir isn't a typical stock that we review on the channel, but it is one that could have incredible growth. As we can see year to date, it is up 143%, which is significantly outperformed the S&P 500, which is up around 17% year to date. Now, before we take a very quick look at their earnings, we can also see it is not even at the 52-week high, which is $20. And for those that don't know, just to make it clear, it does not pay a dividend. Now, in terms of those who have held this stock from around 2020, you would be up around 56%. But again, it does depend at which point you did buy it. As we can see here, the stock did essentially peak at $35 in the beginning of January 2021. And it has trickled all the way down here around to the low sevens not too long ago. So we want to understand, at $15, can we lock in this price and see some incredible growth? $1,500 a share, $15,000. This is what we really want to understand. Now, before we look at the financial statements, just to point out some fresh news, in fact, from yesterday, Cathie Woods buys $12 million of this company. Now, a few things to note. Typically, Cathie Woods, what she does isn't really interesting, but just to point out there, they now have the holding of Palantir as part of their ARK fund at just over 1%. Now, she has been buying and selling this stock, so I realistically wouldn't put any weight on what she does, but just something to make you aware. Now, in terms of their earnings and how they performed, they did report here, as we can see, a 13% increase in their revenue to $533 million for the quarter, and a majority of that has come from government customers. They also expect the full year 2023 to be $2.21 billion in revenue. So quite large numbers. And as you can see, in terms of how they did in the revenue, what we can find out now is that we can see here they reported their earnings in line with analyst estimates. However, the stock did tumble when reported, down 5%. So after hearing this news, what we want to see is there room for growth in Palantir? Should we be looking to buy or should we be looking to sell? Now, revenues year on year, we like to see 3 to 7% growth. Now, top line, December 2018, they reported $595 million in revenue. Fast forward 5 years, December 2022, $1.9 billion, with expected full year, as we heard earlier, for 2023 to be around $2.2 billion. So what I do like straight off the bat is that increase, that consistent increase year on year, very positive to see. Now, how does that affect the bottom line? The net income, is that mirrored? So December 2018, $580 million loss reported on the bottom line. 5 years later, $374 million. So whilst the loss has gotten smaller, we can see, in fact, that it's very inconsistent. So essentially flat December 2018 to 19, then a significant larger loss in 2020, of which then did fall. And we can see now it's still relatively small compared to the 2018 figures, but still they are making a loss. So that'll be interesting when we look at our valuation model shortly. Now, strong, healthy balance sheets, what I like to see is essentially a nice cash balance and a relatively smaller total debt balance. So December 2018, $1.1 billion in terms of their total cash on the balance sheet and short-term investments. Latest quarterly report from a few days ago, $3.1 billion. So a significant amount of cash on the balance sheet, quite healthy, and it has increased over the last 5 years. Now, in terms of their total debt, when we take a look, wow, they had no debt essentially in 2018. Fast forward to their latest report, 246 million. So realistically, this is a very strong balance sheet, significant amount of cash and short-term investments compared to that very minute total debt. So far I like what I see. Now in terms of the financial metrics, well, it's around 33 billion market cap, making it a large cap company. Now earnings per share, as we can see here over the last few years, 2018 negative 1.17, expected 2023 to be positive 26 cents. So it is going in the right direction. As always though, we do prefer to look at the free cash flow, as earnings can be susceptible to manipulation by management through accounting. However, it looks like the story is fairly mirrored. Negative 10 cents of free cash flow in 2018. Expected 2023 positive 21 cents. So again, directionally, it's moving in the right flow. So very good to see. Now, total sales, this is really incredible. We're seeing strong double-digit increases. Total sales, 2018, 600 million. 2022, just shy of 2 billion. So that increase consistent year on year. Very, very strong to see. And their forward guidance showed 2023 expected to be 2.2 billion. So again, very, very good. So the first part of investing is ensuring you're investing in good quality premium companies. The second part, which we're going to cover in our stock valuation model, is ensuring we are getting them at the right price. Now, shares outstanding, we love it when companies do share buybacks, returning excess cash to our shareholders. But what we can see here is the in fact opposite, where they are issuing shares, diluting your ownership as a shareholder. Not surprising given the relative nature of the actual company, but as we can see here, $500 million in shares in 2018, just over 2 billion in 2022. So do be aware of this as an investor. Return on invested capital, interestingly, if you've seen my pinned YouTube video, you know that it's one of my 7 golden dividend metrics. We look for at least 10%, as it means management are effectively allocating their capital. The reason why we're seeing negative here, just to let you know, is due to the fact that the company does not turn over a profit and they are making a loss. Hence, we can see the negative numbers. The one positive to take is directionally it is moving in the right way, and hopefully in 2023, when they release their full annual accounts, or even 2024 at the latest, we see them make a profit. We then move on to the operating margin. Again, due to the fact that they do make a loss, this is not surprising. However, when we look at the free cash flow margin, it looks very good. We like to see around 7% plus, so it's positive to see that realistically nearly every year it has hit that target, just 1 percentage point shy in 2019. Finally, as mentioned, they have a very strong balance sheet, as we can see here. What the net debt to earnings for interest, tax, depreciation, and amortization tells us is the number of years it would take a company to pay off all of its debt, net of cash on hand. As we saw, they could pay it off instantly given the sheer amount of cash they hold versus that total debt. So far, so good. As always, if you are enjoying the content, do hit the like button, do subscribe for more content directly delivered to your doorstep and to join the community. If you want to grab your own copy of the valuation model to essentially run your own companies through, do check the pinned comment and grab a copy. Now, typically with Graham's valuation, we put in the earnings per share, growth rate per analyst estimates, and the current yield on AAA corporate bonds. However, given that this formula, what we can see here is currently the earnings per share trailing 12 months is negative 12 cents. This invalidates the formula, so we will not be able to use Graham's valuation. Likewise, given again the multiples valuation model uses the earnings per share of Palantir, we would not be able to use this model given the fact it is negative. However, if you've seen my previous videos, you know we get companies in a similar sector and size, get their stock price earnings per share, and multiply the average of the PE multiples by the earnings per share of the company we are analyzing. The third model we typically use would be the dividend discount model. Again, because Palantir doesn't offer dividends or give a dividend, we are unable to use this model. So we only have one realistic model, which is probably the most accurate model to derive a valuation of Palantir based on current estimates. So we have here the discounted cash flow model, and as we can see, year on year, the growth has been 28.5%. Analysts estimating around 20%, so I've gone for a little bit more conservative at 17%. With our discount rate, we get the present value of these future free cash flows and terminal value. Once we add them together with the cash, subtract total debt, we get to our equity value, divided by the shares outstanding, gives a DCF price of $22.41. Now, as always, if you are enjoying the content, do hit the like button and do subscribe to join the community and have more videos delivered to your doorstep. Now, intrinsic value typically would be the average of the 4 models. However, given the fact that we only have one model that we've been able to use due to, as explained previously, this gives an intrinsic value on the discounted cash flow valuation model of $22.41. Now, the current trading price is around $15.55. Typically, a margin of safety for a strong company with a wide moat and strong forward-looking data, I would argue 10% is justifiable. However, for Palantir, again, for your own reasons, you could argue a margin of safety much higher. 20% your acceptable buy would be 17, and 30% would be around 15.69 at the current trading price. So what this is saying is if you were to enter into Palantir as a stock at this price 15.55, based on the estimates and judgments we've used today, you would be buying at a 30% margin of safety. Now, Wall Street are forecasting the price over the next 12 months to hit around $14, which actually shows that they believe the current price to be overinflated, overvalued, and therefore they expect it to come down by $1, by around 10%, in fact, $1.50. So, as always, let me know your thoughts in the comments. Are you looking to buy Palantir, looking to sell, or purely speculating? Let me know if you think there is enough growth to drive this company to the intrinsic value we've calculated, or if you also believe this company is heading lower. As always, don't forget to like, subscribe, catch you on the next episode, and have a lovely, lovely day.